it's how to value the social good. Is there any way of valuing social good?
If you just look at,
from a corporate perspective, I mean, as an individual business.
Well, I'd use the market cap. I mean, that's the best thing I can think of, supported by another measure. And I'm going to ask you a question here. What do you think is the measure that is most highly correlated with stock market values? In 1970, the measure was earnings. It had a 50% statistical correlation, 5-year moving average of earnings versus stock price. What do you think? There is a measure today that has a growing, strengthening correlation with the movement of stock market values. It's actually two measures, but sort of related.
Yeah, so it's going to be. Is it R&D as a proportion?
R&D. It's R&D as a proportion of assets is half the story, and that number in America has grown through the roof. I mean, it's been R&D as a percentage of assets is something like 20%. It's grown from 1% to 20% in the last 50 years. Yeah.
Okay.
Yeah. And the other measure, you won't guess this. This is SG&A. The increase in SG&A, selling general administrative expense, it's got everything in it. It's got training expense, marketing and branding, promotion, everything Amazon does. It's not a warehouse. Yeah, it's investment in intangibles, basically. I mean, along with R&D.
Yeah.
So if you take the increase in that number and you add it to the increase in R&D, the statistical correlation with stock prices is really good.
Well, that makes a lot of sense, really, doesn't it? Because if you invest...
Because you're willing to spend money,
right?
And you're not reporting any earnings. See, this stuff is all expensed. So what you're saying is, I trust the market to see that I'm creating value because there's no evidence in the accounting statements. These numbers are reducing your earnings, but the market is interpreting your spending as a value-creating act. This is the new form of investment. Macroeconomists always say, "Oh, American investment is falling. Americans are short-sighted and never invest in their future." Well, if you look at this measure, by that measure, American companies have been investing hugely. So if you want one metric, look at R&D budgets and SG&A, and that will be your clue to how things are going and the payoff from it.
So we're agreeing more than I thought we would, but let me try and put a wedge between us. So talking about ESG, and you also mentioned Michael Jensen's idea of enhanced shareholder.
Enlightened value maximization.
Yeah. It's still kind of shareholder focused, but you're trying to take account of other factors. Yeah. And for me, that's not very far from ESG. And in fact, I was on a podcast with Simon Witney, who's well-known.
I know Simon.
You know Simon?
Yes, I do. Yes.
Well-known private equity and sustainability lawyer.
I've published him.
Oh, right. Yeah. And we didn't have a chance to really go into this because we were talking about something else. But I said that profit is the best measure of corporate sustainability or the good that companies do in the world. And he was diametrically opposed to that. And I said, well, what's your measure? And he said it's not a single factor. It's multidimensional. You have to take into account all of the things that the ESG agenda would take into account. And but I'm still sticking by my guns because having read your book, I think that ESG takes us down the same road that the GFC did with wanting to everyone to have their own house.
It could.
And for Japan to want to have full employment. And it's all of these. They're virtue signals, which they're not bad in themselves, but they are the result of managing a business well. They should not be the yardstick for whether you are managing a business well.
Okay.
Now,
I think both of you are right. So I have this term called the magic of finance capitalism in the book, which is the willingness of investors to assign high PE multiples to investments they either think are going to produce high rates of return or they approve of them socially. And one of the reactions, the interpretations, is that this ends up conferring a lower cost of capital. If investors like what you're doing socially, they will view it as a risk management device. You are less likely to be interfered with by government and political regulators, and they like what they're doing. Those two factors give you a lower cost of capital, which means you have a higher price earnings multiple on the same stream of earnings. So there is a form of magic here in which you can get rewarded. So if you look at Exxon, which is probably the most demonized company in America, well, recently they have made large investments in lithium, blue hydrogen, and carbon sequestration. And I would argue that those investments end up, and they avoided renewables, which BP did, which was a huge mistake. BP destroyed almost half its value by getting into renewables, which they knew nothing about. But Exxon said, what do we know how to do, and which of those things affects society in a positive way? We can do lithium mining because that's like oil. So we're doing both good and well at the same time. So we always have our eye on long-run value maximization. I hate the term profit. The social obligation is not profit. The social goal of a corporation is long-run value maximization.
Yeah, but it's a bit wordy. I know what you mean.
It's the whole stream of earnings.
Long-run value maximization.
Yeah, that is the corporate mission. And Milton Friedman blew it, And some people insist that no, Milton Friedman didn't mean long-run value maximization, which I say that makes absolutely no sense at all. That if Milton said that, then he was wrong.
Well, the trouble with people's interpretation of Milton Friedman is they read his New York Times article like 600 words, and they don't read his 800 word.
You got to substitute for profit is long-run value maximization.
Okay, well maybe I should have
long-run series of earnings.
Yeah, I should have the discipline to say it in long form then.